the moon landing. It cost the world about $300 billion in today's money, the single most expensive thing humanity ever decided to build. Next year, 4 companies will spend more than double that, building artificial intelligence, in one single year. And here's the catch nobody likes to say out loud. Almost none of these AI products actually make a profit yet. It gets stranger. A lot of this money isn't really being spent at all. It's going in a circle. Let me show you the circle. And here's the twist. If you own an index fund, you already have money riding on the answer. For 2 years now, the biggest companies on Earth have been locked in an arms race, and the weapon is raw computing power. Microsoft, Amazon, Google, and Meta are the 4 hyperscalers. Together, they've roughly doubled their AI spending in just 2 years. 2026 alone, their combined capital spending is set to hit around $700 billion. That's up more than 70% in a single year. And this isn't ad budgets or salaries, it's concrete, power lines, and millions of specialized chips buried in warehouses the size of small towns. To grasp the scale, this is one of the largest private building booms in history, and it is happening in under 5 years. Entire power plants are being planned just to keep the servers running. Wall Street thinks this is just the warm-up. Some analysts now expect AI spending to top $1 trillion a year by 2027, which leaves one very awkward question hanging over the whole thing. Where does the money to pay all of this back actually come from? Follow that question, and it leads back to one company, the one selling the tools. But those tools have to be paid for, and that is where the money starts to behave very strangely. There's an old rule about gold rushes. The people who reliably get rich aren't the miners, they're the ones selling the picks and shovels. This particular gold rush, one company sells almost all of the shovels. Its name is Nvidia. These aren't ordinary chips. A single top AI chip can cost tens of thousands of dollars, and the models need them in their thousands. Nvidia makes the chips behind nearly every major AI model, and it sells them at a gross margin of around 73%. In plain English, that is extraordinary. For every dollar of chips it sells, roughly 73 cents is gross profit. Those margins did something no company had done before. For a moment, Nvidia became the most valuable company in the history of the world. So hold this picture in your head. Everyone is spending fortunes on AI, and the one company printing real, reliable profit is the one selling the tools. Watch what actually happens to the money. This is the part that should make you just a little uneasy. In 2025, Nvidia agreed to invest up to $100 billion into OpenAI, the company behind ChatGPT. What does OpenAI do with money from Nvidia? It turns straight around and buys Nvidia chips, by the million. Nvidia's investment flows right back to Nvidia, this time wearing the label revenue, the same dollar, traveling in a circle. Money that leaves Nvidia and comes back to Nvidia as revenue, round and round and round. Investors noticed, and they didn't love it. The word that suddenly started appearing everywhere was circular. And it doesn't stop there. OpenAI also signed a $300 billion deal to rent computing power from Oracle. But to deliver that computing, Oracle has to go and buy more Nvidia chips. The circle just quietly got bigger. Picture a bar tab, where the bartender keeps lending you the money to keep drinking. The till looks busy, but is anyone in the room actually richer? Now, none of this is secret, and none of it is illegal. But it does mean part of this demand is companies quietly funding their own customers. And once revenue is partly money you handed out yourself, one thing becomes almost impossible to measure: the real demand underneath it all. If the buyers are partly funded by the seller, how big is the real market underneath all of this? If all of this feels familiar, it should. We have watched a technology this exciting collide with this much money once before. In the late 90s, the internet was obviously the future, so investors threw fortunes at almost anything with a .com on the end. A company could literally add .com to its name and watch its stock jump overnight, with no profits, and barely a product. Meanwhile, real companies laid thousands of miles of fiber optic cable. The infrastructure was real, and the internet genuinely did change everything. But so much cable was laid that most of it sat unused for years. They called it dark fiber, real infrastructure, with no demand to fill it. The lesson was brutal. You can build the future and still build far too much of it, far too early. And then the market simply broke. The Nasdaq fell about 78% from its peak. Pets.com, the mascot of the whole era, went from a Super Bowl ad to bankruptcy in under a year. But here's the twist that almost everyone forgets. Being completely right about the technology did not save you from losing your money. The future can be entirely real, and the price you paid for it can still be insane. Investors who bought exactly the right idea at the wrong price still lost almost everything. Now let's be fair and build the strongest possible case that this is not a bubble at all. Unlike 1999, the companies doing the spending are giants. They have real profits and real cash, not just hope and borrowed venture money. And AI isn't only a promise about tomorrow. Hundreds of millions of people already use it, every single week. Businesses already use it to write code, answer customers, and draft contracts. Some of that value is very real, and it is growing fast. This is the strongest card the optimists hold, and it deserves to be taken seriously. Even the scariest cautionary tale has a second half. Cisco, the great shovel stock of 1999, fell almost 90%. And yet 25 years later, Cisco finally hit a new record high. The company survived, and the internet won in the end. So the optimist's point is actually simple. A bubble in the stock price doesn't make the underlying technology a lie. So the technology may well win in the end. The open question is who pays for the ride, and when. So what turns very expensive into collapse? It really comes down to one thing: revenue showing up in time. The spending is all happening right now. The profits are supposed to arrive later. The entire bet is that later never becomes too late. This is the real danger of a circle. It can spin faster than anyone expects on the way up, and unwind just as fast on the way down. If the AI revenue disappoints, the first thing companies freeze is capital spending. The building can stop almost overnight. Fewer chip orders hit Nvidia. A weaker Nvidia drags down the funds. The funds drag down the index, and the chain that built it all runs in reverse. It even reaches the physical world. There's a hard limit. You can't conjure gigawatts of electricity overnight, no matter how much money is flying around. Some of these data centers are now waiting years just to get plugged into the grid. Notice, nobody has to be a villain for this to hurt. The revenue simply has to arrive slower than the spending. One slow quarter of revenue, and a chain this tightly wound can start to run backwards fast. And here is why all of this matters to you, even if you've never knowingly bought a single AI stock. 7 companies, the so-called Magnificent Seven, are now about 34% of the entire S&P 500. Together they're worth more than $20 trillion, and almost every one of them is betting enormous sums on AI. Look at the trend. The 10 biggest companies have gone from about a fifth of the index in 2020 to nearly 40% today. If you have a pension or a 401k, this is almost certainly true for you. The whole market you bought is leaning hard on a handful of names. So if you own a plain, simple index fund, you already hold a concentrated bet on artificial intelligence, whether you chose it or not. You never picked these 7 stocks. The index picked them for you, and it picked AI. Now, this is not a reason to panic, and it is absolutely not advice to buy or sell anything. That part is genuinely up to you. It's simply a reason to actually know what you own, because the safe, boring index fund might be far less boring than the name suggests. Concentration cuts both ways. When these giants win, your fund flies, but when they stumble, there are fewer winners left to cushion the fall. A handful of names now move the entire market, up or down. And the honest truth is that nobody knows if the revenue will catch up to the spending, not the analysts, and not even the CEO signing the checks. Which brings us to the only honest place to end, with a choice, not a confident prediction. Because here's the strangest part of the whole story. It can be a bubble and a genuine revolution at exactly the same time. The internet was both. Back in 2000, the websites were wildly overpriced, and yet the web still went on to eat the entire world. And the painful part is this. You usually can't tell which one you're living through until it is already over. So maybe the real question isn't whether AI is a bubble. It's whether you can tell the difference between the future and the price you're paying for it. So what do you think? A real revolution? Or 1999 all over again? Tell me in the comments below. And if you like the calm, sourced version of stories like this one, subscribe. It genuinely helps. This is educational and not financial advice.